Listen up. If you're sitting on silver gains right now and you still don't have an exit plan, you're not investing, you're gambling. And gambling feels fun until the market decides it's done, letting you feel smart. So today, I'm going to give you my silver exit strategy for 2026. How I'm thinking about selling. When I start trimming, what would make me stop, and what would make me buy again after I sell. Silver has been on an absolute tear. And the best part is that it's not just numbers on a screen for a lot of you. Some of you didn't just make money. You made breathing room money. I've gotten messages from people who say this move helped them wipe out credit card balances, clear student loans, or finally step into retirement without that constant background dread. If that's you, I'm genuinely happy for you. Now let me say this. If you want to sell some silver right now and lock the win, I get it. Different goals, different timelines, different stress levels. Nobody should shame you for taking profits. But what I'm doing, and why I'm doing it, might help you avoid the biggest mistake people make after a big run. They confuse a good trade with a permanent identity. Not long ago, silver was hanging around the low to mid-30s per ounce, and now we've been flirting around the $90 area. That kind of move does something dangerous. It tricks your brain into thinking the next move has to be even bigger, even faster, and straight up forever. But markets don't move in straight lines. They move in phases. The real question is, at what point is the easy money already made? And at what point does risk quietly flip against you? Here's where the mainstream noise gets people. When silver is cheap, the headlines ignore it. When silver is moving, the headlines suddenly show up. When silver gets frothy, the same people will start screaming two things at once. It's going to the moon and it's a bubble. They'll get you excited and scared in the same week. That emotional whiplash is how you get shaken out of your own position at the wrong time. So I built a framework that stops me from being hypnotized by dollar signs and headlines. It's simple enough that you can write it down in one line. I don't price silver in dollars, I price silver in gold. That's the gold to silver ratio, or GSR. It's just a comparison tool that answers one brutal question. Is silver cheap or expensive compared to gold right now? Let's do it clean. If gold is $3,300 and silver is $33, then the ratio is 100. That means it takes 100 ounces of silver to buy 1 ounce of gold. When that number is high, silver is historically cheap compared to gold. When that number is low, silver is historically expensive. You can do it in 10 seconds on your phone. Open your calculator, type the gold price, divide by the silver price. That's it. Why not just use dollars? Because the dollar is not a stable measuring stick. It's like measuring your height on an elevator that's going up and down. And when people say just adjust for inflation, what inflation number are you using? Official inflation? Your grocery bill inflation? Over decades, those differences explode. So for historical comparisons, I prefer comparing one monetary metal to another. When you do that, patterns show up cleanly. Over the last few decades, the GSR often lives in a normal zone, roughly somewhere in the 60 to 80 area. That's the middle ground where silver doesn't look screaming cheap or screaming expensive versus gold. Then you get extremes. And extremes are where the money is made. When the ratio was way above 100, silver was cheap relative to gold. That's the kind of setup where you can be early and still be right. That's what I mean when I call it an asymmetric bet. But here's the part people hate hearing. As the ratio compresses, that asymmetry fades. The same trade that was unfair in your favor becomes fair. And then it becomes dangerous if you keep pretending it's still unfair. So, what's my exit strategy? I scale out as the GSR drops. Not sell everything on one dramatic day. In my plan, the first real start selling zone is around a GSR of 50. That's the point where silver has done enough heavy lifting relative to gold that I want to reduce exposure and lock in part of the win. Recently, the ratio dipped just under that level, so I trimmed. I sold about 25% of my paper silver position when the ratio hit that trigger, not because I think silver collapses tomorrow, but because the market was giving me what I asked for, and discipline means you take the gift when it arrives. Selling a piece is not the same as abandoning the thesis. It's risk management. It's how you stay in the game long enough to benefit from the next move instead of handing back your gains in a violent pullback. Now let me underline something. Paper silver gets sold first. Physical silver gets considered last. Paper positions are liquid, fast, easy to rebalance. Physical silver is insurance. It's a hedge against systems breaking. If I ever sell physical, it's after I'm fully out of paper. And even then, I'd likely keep a core stack because life has a way of surprising you. A lot of you are thinking, if silver can keep going up, why sell anything? The honest answer is, it might keep going up. But my sell signal isn't a dollar number. My sell signal is the relationship between silver and gold. Because silver can go to 120 or 150. And if gold is moving too, the ratio might not compress further. So I'm not calling a top. I'm managing a position. This is the difference between guessing and operating. And here's where people accidentally sabotage themselves. I'm not rotating into cash. I'm rotating into something else. Selling silver doesn't mean sitting in fiat and praying for a crash. That's the trap. People sell, feel smart for a week, then watch assets keep inflating, and suddenly they're on the sidelines with shrinking purchasing power and no plan. So my approach is stay invested, reduce volatility, lock asymmetric gains, reallocate. That's rotation, not liquidation. When I sell in increments. Think about how you bought. Most smart buyers don't go all in on one price tick. They buy in batches. That's dollar cost averaging into a position. The same logic applies on the way out. So that first 25% trim is just the first batch. If the ratio continues lower, I keep trimming in steps. Another 15 to 25% if we move into the high 40s, and another batch if we move deeper. And if the ratio reverses and moves higher again, I slow down or pause. This is not a rigid one-way door. It's a decision tree. Now there's a psychological trick here. If you bought silver around the 30s, and it's now near 90, you don't need to sell the whole position to feel relief. You just need to sell enough to change your emotional posture. When you sell a chunk and recoup a big portion of your initial cost, your remaining position starts to feel like a free roll. Psychologically, it changes how you behave. You stop making desperate decisions. And desperate decisions are where profits go to die. What if silver crashes? Could it pull back? Of course. Silver is volatile. But I'm not selling because I expect an imminent crash. I'm selling because the trade has matured. The easy asymmetry is mostly behind us. And historically, when the ratio compresses fast, silver can overshoot and then underperform gold in the next phase. That can simply mean that gold becomes the better risk-adjusted vehicle for the next leg. Here's a cliffhanger. The next phase could be the most frustrating outcome for silver-only holders. Silver goes up, but you still underperform the smarter rotation. You made money, but you didn't make as much as you could have because you stayed emotionally attached to one asset. This is capital allocation, not identity. Some people treat silver like a religion. I don't. I treat it like a tool. Frameworks are warnings. The reason I talk about ratios is so you don't need a perfect alert. You need a repeatable method. There will always be another setup. Maybe not tomorrow, maybe not next month. But markets rotate and extremes return. Would I ever buy silver again after selling? Yes, absolutely. If the ratio widens back out, if silver becomes cheap relative to gold again, I would rebuild the position. No emotional attachment, no ego. If the math says the asymmetry is back, I'll take the trade again. Now let's get tactical, because 2026 is not going to be a gentle year. I'm watching the GSR like a hawk, and I'm treating 50 as a major pivot level. If we compress into the 40s, that's a different world. That's where silver is historically expensive, relative to gold. And that's where I expect sentiment to get manic. When sentiment gets manic, the market starts punishing late arrivals. That's usually when you want to be the calm person, selling to the excited person. So if we go into the 40s, I'm likely trimming more. And if we go even lower into the low 40s or high 30s, then I'm probably close to done with paper silver. But even while I'm trimming silver, I'm still bullish on precious metals as a theme. Currency debasement doesn't stop just because you sold one position, so I'm not leaving the arena. I'm repositioning inside it. What do you rotate into? Conceptually, rotation means moving from the asset that has become relatively expensive into the asset that is still relatively cheap. For me, that could mean increasing gold exposure when silver has outperformed. It could mean keeping a diversified basket that includes metals, equities, and select real assets. And this is where your personal goals come in. Are you trying to maximize returns or reduce risk while keeping purchasing power? Those are not the same mission. Now, I know some of you are thinking, but gold and silver move together, so isn't this overcomplicated? Most of the time, they do move in the same general direction. But the ratio tells you which one is leading and which one is lagging. Here's the logic. Imagine gold is 3,300 and silver is 66. That ratio is 50. Now imagine both metals double. Gold goes to 6,600 and silver goes to 132. The ratio is still 50. You can have huge dollar gains, while the ratio says nothing has changed in relative value. Why does 50 matter? It's just a zone where historically silver stops being the obvious underdog and starts acting like the star of the show. And when silver becomes the star, volatility follows. Volatility is what shakes people out. It's what turns strong hands into weak hands. So if you can use a ratio framework to reduce the chances of emotional whiplash, you're already ahead of most market participants. The moment silver becomes the center of attention, the incentives change. More leverage shows up. More short-term money shows up. More people jump in with zero plan and maximum confidence. That's when you start seeing violent candles in both directions. So when I trim at a ratio like 50, I'm acknowledging that the easy part of the trade is done, and the hard part begins. There's one scenario that makes me hit pause even if the ratio is flirting with my levels. If the ratio snaps back upward quickly after a sharp compression, that tells me the market may be transitioning into a different phase. In that case, I'd rather wait, because whipsaws are where you get chopped up. If you're wondering how to build your own decision tree, here's a simple template. Pick a level where you start trimming. Pick a deeper level where you trim again. Pick a stretch level where you're mostly done with paper. Pick a re-entry level where you'd consider buying again if the ratio widens later. 4 steps. You can refine it later, but you can't refine what doesn't exist. Position sizing matters. If you were all in on silver, then every tiny move feels like a life or death event. If silver is one part of a broader portfolio, you can be calm. You can follow your framework. If you're feeling addicted to the price, that's not a sign you're bullish. That's a sign your position is too big for your nervous system. The market will punish you for being right in the wrong way. You can be right on direction and still lose if you're over-leveraged, oversized, or emotionally sloppy. The market doesn't grade on correctness. It grades on execution. Rotation means you're moving from one expression of a macro theme into another expression of the same macro theme. If the theme is currency debasement and hard assets, then silver and gold are both expressions of that. Your job is to decide which expression offers the best mix of upside and survivability at each phase. I don't need to predict the future to manage this well. I don't need a perfect macro forecast. I just need a framework that reacts to what the market is actually doing. The ratio is a reaction framework. If silver outperforms gold and the ratio compresses, then gold often becomes more attractive relative to silver. One clean rotation is silver into gold when the ratio is stretched. Another approach is to simply rebalance. Trim the outperformer, add the underperformer. Rebalancing sounds boring, but boring is where wealth hides. Physical silver has two jobs: financial and psychological. Financially, it's a hard asset that doesn't depend on an app or a counterparty. Psychologically, it's the part of your portfolio that lets you sleep when the world feels unstable. So when I say physical gets sold last, what I'm really saying is physical is not there to maximize returns. Physical is there to maximize resilience. A lot of people ask, why not just sell it all now and buy back later? Because later is not guaranteed to be cheaper. People underestimate how hard it is to buy back in after you sell. If price runs higher, you feel stupid. If price dips, you feel like you should wait for lower, and then you miss the re-entry entirely. That's why scaling is so powerful. What if the ratio goes lower than anyone expects? Then my framework continues to work. I continue to scale out. I don't fight it. I use it. My framework is not there to make me feel smart. It's there to keep me consistent. Consistency beats genius in markets. What if you're late? If you feel like you missed the move, you have two options: chase or learn the framework and wait for the next extreme. Chasing feels productive, but it's often expensive. Frameworks feel slow, but they pay. So if you feel late, don't panic buy. Build the habit of watching relative value. That skill will outlast any one trade. Now let's tie this together. The biggest risk is not that silver goes down. The biggest risk is that silver goes sideways while something else becomes the real opportunity and you miss it because you're emotionally married to your last win. So use silver. Don't become silver. Here's the plan in a simple sequence. If the ratio hovers around my trigger zone and chops sideways, I'm patient. I already trimmed the first portion, and the rest gets handled only if the market earns it. If the ratio compresses deeper, I keep trimming in batches. If the ratio snaps back up hard after a compression, I slow down. Whipsaws are how good plans get ruined by impatience. And if the ratio widens out over time and silver becomes cheap relative to gold again, I'm open to rebuilding. There's no step in my plan that says panic. There's no step that says sell everything because someone on TV yelled. There's no step that says buy more because a stranger promised $500 silver next month. The real enemy isn't the market. The real enemy is you on a bad day, making a permanent decision based on a temporary emotion. So here's how I protect myself from myself. I write my levels down. I decide my increments in advance. And I accept that I will never capture the exact top. I'm fine with that, because I'm also choosing not to capture the exact bottom of the next pullback with my full position. Physical is not a day trade. Physical has premiums, spreads, and timing issues. Physical is also the part of your portfolio that doesn't need permission to exist, so I treat it with respect. I don't dump it casually. And if I ever do sell some physical, it's deliberate, it's later, and it's after paper's fully handled. If you're new and you're trying to build a stack, remember this. A stack without a plan turns into stress. A stack with a plan turns into confidence. If you're sitting on big gains, you're going to feel pressure from two sides. On one side, you'll hear sell now. It's over. On the other side, you'll hear never sell. It's going to infinity. Both extremes are designed to hijack your decision-making. Your job is to stay in the middle with a framework and execute in increments. Now I want to hear from you. What is your first trim level on the ratio? And what is your I'm basically done level? 2 numbers. Put them in the comments. And if you're not using the ratio at all, tell me what you are using. No judgment, just honesty. Also, if you've had a win, big or small, share it. Drop it in the comments. People underestimate how motivating that is for others. Final takeaway. I'm still bullish on the broader hard asset theme. I'm not anti-silver. I'm pro-discipline. I'm pro-rotation. I'm pro-locking wins when the market gives them to you. So I'll keep selling paper silver in steps if the ratio keeps compressing. I'll keep physical as long-term insurance. and I'll stay ready to rebuild a silver position if the ratio stretches back out later. Because the market always gives a second chance, but it only gives it to people who are still liquid, still disciplined, and still paying attention. If this helped, subscribe right now, and drop a comment so I can see who's really backing this work. Take care of yourselves. I'll see you in the next one.